This is Nightly Business Report with Tyler Matheson and Sue Herrera.
A tale of two tech stocks. One beat earning expectations by a lot, the other missed by a lot. And one may be a better long-term investment than the other.
Protecting your privacy. Broadband providers now need your permission to sell your digital information. A win for consumers, a blow to telecom and cable companies.
Final stretch, why issues surrounding trade and agriculture could tip the scales in the battleground state of Georgia. Those stories and more tonight on Nightly Business Report for Thursday, October 27th.
Good evening, everyone, and welcome. Two powerful tech companies reported very different quarterly results late today. We begin with Amazon and its big earnings miss, not coming anywhere near where Wall Street was expecting. And one reason was a sharp rise in the e-commerce company's shipping costs, which rose more than 40%. Other expenses included investments in new growth markets like fashion and beauty. Here are the numbers. Amazon earned 52 cents a share. Wall Street was looking for 78 cents. Revenue rose 29% from a year ago to $32 billion, but its sales guidance wasn't as strong as some would have liked. That sent shares lower in initial after-hours trading. Deirdre Bosa has the one key takeaway from Amazon's results.
Over the last two quarters, Amazon has blown earnings expectations out of the water. So when it came up short this time, the stock sold off in the after hours. A key takeaway is its revenue guidance for the fourth quarter. Amazon was expected to make a killing in the e-commerce space during the all-important holiday shopping season, but its outlook fell a little short. On the bright side, its key cloud business continues to grow at a healthy click, 55% in the last quarter. For Nightly Business Report, Deirdre Bosa, San Francisco.
Meantime, Alphabet, the world's second largest company by market valuation and the parent of Google, reported its profits today, too. And they blew past Wall Street expectations. The company also reported a double-digit increase in sales, helped by strong sales of ads on mobile devices, a market in which it is one of the dominant players. Now, Alphabet earned $9.06 a share. That was a full 43 cents better than expectations. Revenue was up about 20% to more than $22 billion. And that, along with plans to repurchase $7 billion of its Class C shares, helped the stock rise, as you see right there, in initial after-hours trading. John Fort takes a closer look at Alphabet's quarter.
Google out with earnings after the bell that beat analyst expectations on the top and bottom line. But the real number that you need to pay attention to in this report is paid clicks. They are through the roof, mainly because of growth at YouTube. That continues to be a bigger and bigger share of Google's advertising revenue. Mobile is a part of that, and it is absolutely driving results. For Nightly Business Report, I'm John Fort.
So as we said, it was two very different earnings outcomes for Amazon and Google's parent company, Alphabet. Despite the mixed results, which one might be a better long-term investment in your portfolio? Dan Morgan joins us. He's the senior portfolio manager at Synovus Trust. He owns shares of both companies, and he joins us now. Dan, nice to see you again. Welcome back.
How you doing?
Let me start, first of all, with Amazon's miss. Were you surprised?
It was a little bit disappointing. Revenue was pretty much in line. As you said, earnings was way below. And, you know, we know that Bezos is known to spend money on new future products and fulfillment centers. You mentioned some of the things that they spent money that really increased over this quarter. But it was a little bit disappointing because we kind of thought some of that had gotten behind us a little bit. And now we're going to start getting some of the benefits of all those future or past costs associated with that. The big factor there,
it seems, was the cost of shipping, which has gone up. Does Amazon, and I know they've made some steps in this direction, does Amazon need to capture more of its own shipping? In other words, build its own network?
Well, it's interesting, Tyler, because when you look at the increase in Prime, right, which is free shipping, right, $99, you buy stuff and you get free shipping. One of the concerns with that was that it was going to eat into margins a little bit or eat into cost because now Amazon is taking on that cost. So you're presenting an interesting proposal, which is, do they start kind of taking care of that and trying to bring that cost down, so opposed to relying on the U.S. Post Office or UPS or something? So that's kind of an interesting dynamic of the whole Prime phenomenon.
Now, let's switch to Google and Alphabet, its parent company. That was the opposite issue. Really, it outperformed on its earnings on the top and bottom line. You own both shares, Dan. Are you more inclined towards Google and Alphabet at this point than you are to Amazon?
Well, Sue, it's hard just on one quarter to make a judgment. I mean, Amazon is still really, really interesting in the fact that we haven't talked about their AWS or web service group. It was up about 55%. They did about $3.2 billion, and that whole cloud component on Amazon makes it very interesting. But Google is very interesting too, and the fact we haven't talked about the things they've done with their artificial intelligence chips. They just came out with a new phone, the Pixel. It's about $650. So they're doing some things that may really set them apart in terms of technology that they have that other people don't. So, both companies we both own both companies, like both companies. Again, it's very hard to say just because one missed and one did well in the quarter, we're going to get rid of our Amazon and buy our Google. I think they're both really, really interesting companies in terms of the things they're doing away from their core businesses.
All right, on that note, Dan, thank you so much. Dan Morgan with Synovus Trust.
On Wall Street, stocks dropped on the busiest day of earnings season. Investors also reacted to the rise in bond yields around the globe, closing in on 2% here in the U.S. The Dow Jones Industrial Average fell 29 points to 18,169. NASDAQ off 34. The S&P 500 dropped 6.
The biggest chip deal in history was made official. Qualcomm will buy NXP Semiconductor for $39 billion. As we've reported, the two companies have been in talks for a while, and it follows a wave of other chip makers who have merged. The Qualcomm CEO says this deal will extend Qualcomm's reach beyond smartphones.
If you look at the larger context of what's happening in the industry, the car and the Internet of Things, the technology roadmap and the amount of technology and technological change that's going to occur in both those industries, it reminds me of what the smartphone looked like in 2000, before there was a smartphone. Everyone was trying to figure out how do you assemble all of the assets, the technology breadth to be successful in that huge transition. That same thing's going to happen in the Internet of Things, same thing's going to happen in automotive, and we're happy to have the big pieces to be able to drive it.
Shares of both NXP and Qualcomm rose in trading today.
Gannett's potential takeover of Trunk may be in doubt. As first reported by Bloomberg, the banks involved in financing the deal are backing out. Gannett, the owner of USA Today, wanted to buy Trunk to create a company that could better compete with online news sites. So what the heck is Trunk? It's the company formerly known as Tribune Publishing, owner of the LA Times, among other properties. A report from Reuters, however, says the two companies remain in advanced talks. But the damage was done. Trunk dropped nearly 28%, Gannett down 17%.
UPS delivered on revenue in the latest quarter, beating Wall Street expectations. The world's largest package delivery company said it was helped by a rise in the number of daily shipments. But as Morgan Brennan reports, UPS has turned its attention to what it expects to be another record-breaking holiday season.
UPS is gearing up for another record holiday season. The delivery giant expects to move more than 700 million packages between Thanksgiving and New Year's Eve, a staggering sum that's 14% more than last year. There are 2 additional delivery days on the calendar this holiday season, but the big jump can still be largely attributed to the persistent surge in online shopping activity.
We'll see over 60% of those days having over 30 million packages. And just a few years ago, we might have had 2 or 3 days over 30 million. But we're prepared. We've been spending the entire year making sure that we can make the necessary adjustments, collaborating with our customers, and ensuring that we're going to deliver a great Christmas season for everybody around the world.
To get it right, UPS is deploying a specialized routing software in all of its U.S. delivery trucks, adding temporary facilities to help handle the flood of packages, and recruiting some 95,000 seasonal workers. Those details coming on the heels of earnings results this morning as well, with UPS reporting that profit and revenue both grew last quarter, and the company on track to hit its 2016 guidance. As e-commerce demand continues to soar and as more retailers look to have goods moved as quickly as possible, UPS is also making a bigger long-term investment that won't begin to pay off until late next year. The company is purchasing more planes for the first time since 2013, expanding its existing fleet of over 500 owned and leased jets, And it isn't disclosing the cost of the Boeing 747-8 freighters, but the list price is in the billions of dollars. Analysts say the big bet stokes uncertainty. One reason the stock came under pressure today.
If it modernizes the fleet, lowers the cost of shipping, more fuel efficient, then it's great news. It can help margins. That's certainly what it did for FedEx. If it doesn't, if it just increases capacity and puts pressure on global pricing for air freight shipments, then that's bad.
But heading into the final months of 2016, it's still all about the peak holiday season, as UPS and rival FedEx prepared to deliver a record number of gifts to consumers. And if all goes well, solid returns to investors. For Nightly Business Report, I'm Morgan Brennan.
Still ahead, big investment. Why one candidate for president wants to spend $1 trillion fixing our roads, bridges, and more. The Federal Communications Commission today approved unprecedented new rules to protect your online privacy. It is a win for consumers, but a blow to broadband providers. Hampton Pearson has more on these sweeping new regulations.
This is your agenda for today.
Federal Communications Commissioners voted 3-2 to approve first-time privacy rules for broadband. From now on, internet service providers like AT&T, Comcast, and Verizon must get consent from consumers before using sensitive data, like a customer's web browsing history or what apps are used, for marketing and advertising.
It is the consumer's information. It is not the information of the network the consumer hires to deliver that information.
Republican Commission members oppose the new policy. They say it unfairly gives websites like Facebook, Twitter, and Google the ability to harvest more data than service providers.
Nothing in these rules will stop edge providers from harvesting and monetizing your data, whether it's the websites you watch, what you visit, or the YouTube videos you watch, or the emails you send, or the search terms you enter on any of your devices.
The new FCC policy comes just days after AT&T and Time Warner announced an $85 billion proposed merger, with joining forces to compete for targeted ads as a selling point. Now they may have less access to consumer data. Anti-regulation groups say even more restrictions may be coming.
This is just one first step towards pushing us to a more European-style, heavily restrictive approach to privacy, and that would be bad for the entire internet and for innovation.
No surprise, consumer advocates generally like the new plan because it's closer to long-standing Federal Trade Commission privacy policy, including rules aimed at preventing identity theft and the unauthorized sale of private data. For Nightly Business Report, I'm Hampton Pearson in Washington.
To politics, Republican presidential candidate Donald Trump has a plan to spend $1 trillion on infrastructure over the next decade. The outline, drafted by his advisors, relies on private funding. John Harwood is following the story for us from Washington. John, Mr. Trump has been speaking about spending lots of money on infrastructure for some time now. Is the price tag here what's new, or is there other things here that are new?
The price tag's the same. He's been saying $1 trillion for a while, Sue. What's new is that his advisors, Peter Navarro and Wilbur Ross, outlined how the fund that they're proposing would actually work. And essentially, they're saying that private investors would put up $167 billion, and the rest would be borrowed money. And the money would be repaid by the revenue streams from projects that they would be building.
So, John, how does this proposal compare with Hillary Clinton's?
Well, it's twice as big as Hillary Clinton. She's got a $500 billion infrastructure proposal. A bunch of that, more than half of it, would be direct public spending. But Hillary Clinton would also create a similar private fund, an infrastructure bank, with $25 billion to also try to leverage private investment. One of the key differences is Donald Trump's program would apply to programs with dedicated revenue streams, user fees on the people who'd consume it. Hillary Clinton's does not have that restriction. Therefore, it would be generally available infrastructure. Some people might object to the privatization component in Donald Trump's plan.
Given how close we are to this election, John, might this proposal make a significant difference in the race at this point or not?
I doubt it. Policy at this point doesn't really break through given how much is known about these candidates. But the idea of putting a lot of people to work, building infrastructure is something with appeal in the states like Ohio and Pennsylvania that Donald Trump is counting on for his electoral vote majority if he can get one. But of course, we know that he's down about 6 points in national polls. He's got a long road to travel to get back in this race.
So just so that I'm clear here, Mr. Trump's plan would target things like toll roads that have revenue streams, airports that have revenue generating capacity, right?
They say that they are not in favor of toll roads themselves. They haven't really laid out all of the elements, but it would have dedicated user funds. That is how they say they would get borrowing costs down by reducing risk.
All right, John, thank you so much. John Harwood in Washington.
And now to the Clinton camp, where a newly leaked memo indicates that two chief fundraisers for the Clinton Foundation urged donors to steer business, including paid speech opportunities, to former President Bill Clinton. Eamon Javers joins us now with more on this intersection of political power and business. Eamon, what did we learn today that we didn't already know?
Well, Tyler, for one thing, that we learned that President Clinton's former top aide, Doug Band, thought of himself really as the CEO of Clinton Inc., and maybe Bill Clinton as the chairman of that enterprise. And Doug Band laid out in this stolen memo an elaborate strategy whereby all of the different elements of the Clinton universe would raise money and generate profits from pretty much the same group of clients. So the Clinton Foundation, the Clinton Global Initiative, those are the charitable arms, Bill Clinton personally in terms of speeches that he gave, and then Doug Band's own private consulting firm called Teneo would all hit up the same set of clients for donations and for revenue. That was an intentional effort going back to the early days of Bill Clinton's post-presidency.
Is any of this illegal?
It doesn't seem to be illegal. As of right now, we're not seeing any evidence in these WikiLeaks emails that anybody traded favors in exchange for these donations. We're not seeing any indication of any illegal money changing hands. What we are seeing is something that a lot of voters won't necessarily like the smell of, which is intertwining these charitable operations with Bill Clinton's own personal efforts to make money for himself and for his family, and the lifestyle, the private jets, the hotels, and all of that. All of it is spelled out in enormous detail in these emails.
Some would call this ingenious cross-selling, wouldn't they? And others would say this was pay for access. Which is
interesting choice of phrase. And what you don't see in any of these emails, or at least I haven't seen, having read a lot of them now, is any indication that the Clinton people gave a whole lot of thought to what it was these donors thought they were buying. Why would you want to buy this much time of Bill Clinton? Why would you want to spend this much money on his charitable enterprises? Why would you want to give him your private plane to use for the afternoon? All of that seems to be sort of a blind spot by the Clinton people. And then, of course, we're also learning a whole lot about the really significant infighting between Chelsea Clinton and Doug Band, a fascinating sort of Oedipal struggle there between Bill Clinton's daughter and a staffer that a lot of people considered to be Bill Clinton's moral equivalent of an adopted son. Fascinating dispute there as well.
More to come.
Eamon, thanks very much. Yeah, fascinating insights into palace intrigue. Eamon Javers in Washington.
North America dings Ford's results, and that's where we begin tonight's market focus. The automaker said a drop in North American sales and costs associated with the company's door latch recall caused profit to slip by more than half. Nonetheless, the results were still better than analysts' estimates. The company also said it plans to cut back on production in the current quarter. Ford shares were off 1% to $11.74. Profit and revenue at Twitter climbed in its latest quarter, beating street expectations. And in an effort to turn a profit next year, the company plans to lay off 9% of its total workforce. That's about 350 employees. Twitter rose 11 cents to $17.40. The energy company ConocoPhillips narrows its loss more than expected, thanks in part to cost cuts. The company reported a drop in revenue as a rise in oil production was offset by lower selling prices due to the ongoing commodities slump. Conoco also trimmed its capital budget outlook for 2016. Shares were up 5% to $44 even. And the health insurer Aetna topped analyst earnings expectations, helped in part by higher fees and cost cuts. The company, which has said it will discontinue its participation in most of the affordable care plans, added it expects losses from those government plans to persist. The company's CEO says the flawed exchange isn't expected to improve anytime soon.
We need to fix the risk adjustment program. This population has clearly got more morbidity than had been initially anticipated. And if we can fix risk adjustment, we can stabilize the market. But until that happens, it's only going to get worse.
Aetna was off a fraction to 110.83.
Bristol-Myers Squibb said robust drug sales lifted profit and revenue above estimates. The solid results prompted Bristol to raise its 2016 guidance and launch a $3 billion share buyback program. The company's CEO says the future is bright.
We have really exciting, potentially innovative medicines, not only in oncology, in heart failure, immunoscience, fibrosis. All of those programs are moving forward, and the long-term prospects for the growth of the company are really good.
Shares rose nearly 5.5% on the session to 51.96. Community Health Systems warned of a third-quarter loss ahead of its quarterly earnings report next week. The hospital operator said fewer patient admissions would cause revenue to take a hit. Community Health stock was also downgraded by two banks following the news. Shares were cut in half, closing at $5.05. Shares of GNC Holdings took a dive after the vitamin and supplement company posted lower profit and revenue that missed estimates. The company also said same-store sales fell. Management says it's addressing key issues that it hopes will kickstart growth. Investors didn't hang around today to find out. Shares plunged nearly 25% to $15.13. And China-based shipping company ZTO Express made an inauspicious stock market debut today, raising almost $1.5 billion in its initial public offering. That's the largest in the U.S. this year. That's the good news. The less good news is that the stock opened at $18.40. That was a full dollar below the company's initial offer price, and shares begin to swoon from there, ending the day down 15% to $16.57.
Coming up, why Georgia, home to Delta, Home Depot, and Coke, is now a battleground state in the race for the White House. Here's a look at what to watch for tomorrow. Big oil earnings from Dow Components, ExxonMobil, and Chevron are out. We'll find out how fast the economy grew in the third quarter with the release of the GDP report. And we'll also get a fresh read on consumer sentiment. And that's what to watch for on Friday.
Agriculture and trade are two economic issues voters of Georgia are thinking about ahead of Election Day. And while Georgia historically votes Republican, this election cycle, nothing is certain. Andrew Ross Sorkin reports tonight from this somewhat surprising battleground state.
With 2 weeks to the election, we are in Georgia, which is turning into a battleground state, talking to local business people, politicians, and others about what are the most important economic issues here in Georgia. Georgia is joining the list of typically conservative states that have turned into battlegrounds in the 2016 election.
The Atlanta Journal-Constitution poll actually showed Clinton ahead by 4 points in August. That was also after the really rough week for Trump's campaign. But it's been close throughout, and I still think it will be a close election.
The Peach State has voted for a Republican in the past 5 presidential races. While Trump is leading, changing demographics and a skeptical Republican base have helped move the needle to the left in recent polls.
To close the gap, we have folks on the ground. We have 13 field offices across the state. We're running competitive state house races and state senate races, and we're knocking the doors. We are getting all of the field done that we can.
Agriculture is a top campaign issue. The state's known for cotton, soybeans, and of course, Georgia peaches. But the top exports, according to the Census Bureau, are aircrafts and engine parts. Georgia is home to multiple shipping ports, meaning trade and the Trans-Pacific Partnership are top of mind.
You have to have open trade. America's always had open trade. What we haven't had is fair trade. And what Donald Trump is talking about is creating a level playing field.
The poultry industry continues to dominate the northern part of the state and textile manufacturing in the west. Atlanta is a major hub for employment. It's home to Fortune 500 companies like Delta, Home Depot, and UPS.
As a business owner, I do 3 things. I try and grow revenue, control expenses, and invest capital. And I think the country obviously needs to do the same things.
Early voting in Georgia began last week, but has been complicated by Hurricane Matthew. The state's top election official refusing to extend voter registration deadlines in counties hit hardest by the storm, prompting criticism from voting activists. Trump is still ahead in the polls, but Clinton is gaining ground as we head into the final stretch. For Nightly Business Report, I'm Andrew Ross Sorkin, Atlanta, Georgia.
And that is Nightly Business Report for tonight. I'm Sue Herrera. Thanks for joining us.
And I'm Tyler Mathisen. Have a great evening, everybody. We'll hope to see you right back here for Nightly Business Report tomorrow night.